if markets have been bullish over a period of time, maybe few weeks, a couple of months, you would see smallest correction of 1 or 2 percentage points actually having a tendency to bring in a lot more flows. Putting money by sorting the funds on returns without looking at the capability of downside protection of the fund. The behavior is exhibiting is a FOMO. When the market was a slightly bullish kind of zone and you were probably underinvested, and even a slightest correction makes you double down on the missed opportunity a lot more than they should. And a lot of young investors dabble into derivatives, and I would probably call it speculative way of trading and not investing. I think they lack an access to product which is managed by Next.
Mira Asset Investment Managers presents a new conversational series, Let's Tech, Tech with an X. Hello everyone. Welcome to another episode of Let's Tech. Today we have come all the way to Gurgaon, not just a COO, but a very passionate technology person and very passionate in money management. Let's welcome Santosh. Santosh from ET Money. Welcome to the...
Hi, Srini. Pleasure to be here. Thanks for having me.
Now, as we are all aware, this is one platform which was the early adopters of platform business in the country and took an early step in democratizing investments, taking it to more households.
Yeah.
And doing it on the direct plans also. So that was something, an interesting journey. But before we go there and talk a little bit more about the experiences that you've had building this, first of all, I want to start off with your early days. What makes you land up in the money management piece?
Yeah, so actually, it was not a planned move to be in money management. I was a typical engineer and MBA, wanting to be a marketeer all my life. I ended up being one. My first job and second job both were actually in very different areas of marketing discipline. One was into relationship marketing services, and second was into mobile advertising on mobile internet before people started using mobile even on 2G phones. So both these things...
WAP days or even earlier?
The WAP days, actually. You're right. So coming to the question here, so my first two stints were actually into jobs which made me make people aware about marketing discipline, which was not really accessible to everybody. And while working on all these experiences, taught me that the customer problem, or you don't empathize with customer situation, you are not really doing a great business as such. You can be under attack by the competition at any point of time. And working on these two assignments made us, probably a couple of my colleagues and myself, always wanting to do something very big to solve customer problems. And I still remember in my B school days, one of the things which I never wanted to do was actually getting into kind of, biz dev, sales, marketing roles in BFSI companies, because I never saw that I can do one. And finance never interested me, to be honest. But when there was this itch to really start something on my own at the age of 28, and obsession to solve some customer problems, Mukesh, the co-founder of Money Sites with me, and right now CEO of ET Money, both of us have been like buddies since our college days, and both of us really got kind of, I would not say looted, but somewhere got missold some financial products during our initial journey into earning incomes. And we felt that this is a problem which is actually because of lack of information, a lack of informed decision making, and of course lack of education as well. And probably towards the 9 days. And internet was one of the best ways to solve that problem, because you can analyze truckloads of information, you can organize information, you can present information, you can make information interactive. So all these things allowed us to get into money management in unknown ways. And our initial aim was only to solve problems. We were never about what kind of business model we will have, what kind of, whether we'll get into distribution, whether we get into advertising. We didn't know that. So it's been a fascinating journey, but I think the biggest thing is we still obsessed about solving customer problems.
So two friends decided to do something together, and today here we are.
Yes, yes.
Great. You did mention one moment which actually triggered this thought, but in this process, have there been any pivotal moments that really took you up onto this line that, this is a problem we have to solve? Maybe.
Yeah, a lot actually. I think so. Maybe we can go into some instances, but I'm not sure how do we put that. But I think in 2007-8 days, everybody used to get sold more of ULIPs and endowment policies in the name of life insurance and tax saving than actually mutual funds. Mutual funds was not as big as insurance was, and it was because of commissions. And I'm when I say that, I'm not really saying that insurance policies are bad. I don't hold that opinion that every insurance policy which is not term life is actually bad. I think with time things change. Industries evolve, commission structures evolve, products evolve. And today there are fantastic opportunities where you can actually solve some kind of problems in your financial security via insurance products as well. So I'm not going into that, but in those days, products were really bad. And I think both of us got missold some kind of policies where we felt that if we are well-educated, well-read people and can fall into these kind of traps, maybe many people would be. There were also things that we were actually quite evolved spenders. I think most of my money in those days, forget about now, used to be through credit cards. And even picking the best credit card in those days was quite tough. So I think both these problems, along with the boom of 2005, 2007 in the stock market, of course, we also dabbled in stocks in those days, knowingly, unknowingly, and made some mistakes, made some money. But we realized the structure was missing. I think a lot of investment decisions were making on impulse. So when we looked at our own behaviors, we felt that this is an interesting problem to solve because most of the problems are there because of lack of information or lack of analysis of the information available. And we wanted to really solve this problem. And I think the biggest pivotal moment was all these three, that we dabbled in stocks, we dabbled in cards, we dabbled in insurance policies unknowingly. And we felt that this can be solved really, really well. And I think maybe in 2009, 2010 days was way too ahead of the market. I think internet payment systems were not there. And we were expecting people to invest online. So probably we were ahead of the market at that point of time. But if you look at what happened in 2014, once the new government came in that point of time and markets rallied, I think demonetization happened in 16. And I think GST came in later. I think a lot of financialization of economy.
UPI 1, demon, and the first range of interest rate cuts from 2016 to 2019.
Yes, right? Yes.
Around 270 basis points went down.
Yeah.
2016 is actually a very pivotal year.
Yes. Yeah. All the things that you mentioned as well. Yeah. I think a lot of things came together. I think we are probably lucky entrepreneurs, in my opinion, where we got probably tailwinds into the business and not headwinds which typically face. Right from those like 2016 days to even 2020, 2021, I think India has seen so many things which I would actually term externalities happening in the business, where the business of wealth management or financialization of savings overall, be it digital lending as well, or even insurance. Everything is picked up so fast, and it is not just the effort of the entrepreneurs, but also the ecosystem which the government has created. The infrastructure, the digital infrastructure India has is probably unparalleled. And I think all these 5-7 years have seen a lot of pivotal moments, unknowingly, knowingly, which probably have contributed to the growth of the fintech ecosystem in the country. Yeah. So I think it's not something which happened probably only for me. I think it's happened for everybody else in the country as well.
Yeah, across the industry. Nice, across the industry, because even your movie tickets and your airlines and train, everything got sort of, on the internet and on the application, which has completely changed.
Yeah.
But then there are B2B platforms and there's a B2C platform.
Yes.
Could you probably just put down for us that, what is the one major difference when you look at these two platforms? And on B2C, how does biases, cloud your mind when people try to do investments using that?
So I think B2B platforms, essentially, if when we talk about the industry that we are in, is about building it for the intermediaries, right? A lot of entrepreneurs, a lot of companies are actually serving that need today as well. And a B2C is different ball game altogether, but probably we can tackle one by one. I think when you are building it for the intermediaries, the challenges are very different for you compared to the challenges that you are going to face in B2C. For instance, for intermediary, when you are building something, many people have some stated problems and a lot of people have unstated problems. But maybe sometimes the bigger opportunity lies in unstated problems, which the intermediary may not realize because they are used to operating in certain kind of way all the time. So when you take a piece of technology to them, they may not realize what it can do for them, right? And I probably had a first-hand experience of this in my entrepreneurial journey as well. So, but when you go to B2C, when you're talking about an end consumer and kind of, expecting them to really transact into financial products, which probably they've never bought offline. Like, I keep saying this all the time when we take discs internally, like, people always used to buy books, but we changed our mode of purchase from offline to online. We always bought mobile phones, but we changed our focus or rather our mode of purchase from offline to online. We always kind of hailed taxis by showing our hand on the road and got into the rickshaw or the kind of taxi. But we changed our mode of purchase to online or applications in that sense. So, but people never invested in financial products in the offline world at scale ever. And here we come and say that you people expect we expect you to really buy products which you never understood in the offline world. I think the biggest challenge has been to grow the market. I think the digital infrastructure helped it easy, made it easy for people like us to cater to customers who will always on the fence, who wanted to really do online, but were not able to do online. So probably we cater to them. I think the stock market rally, the past returns, seeing everybody make more money around them. And of course, the COVID-led behavioral changes that caused. I think those things came together and solved the growth problem for the industry. The complexity of building it for a B2C audience in today's times is far more difficult than what even for B2B audience.
The multiple of 10 or more?
Maybe infinite, I guess. Because, the biggest challenge really comes in that, we understand asset allocation. We understand diversification. We understand rebalancing. We understand maybe tax loss harvesting, tax gain harvesting. We understand impact of exit loads. We understand impact of daily negative impact of tracking daily values in your portfolio. Right. But customers don't. How do you really communicate about things which they don't really appreciate in as much depth as you want them to be?
Of course, what you said is absolutely right. COVID did change that outlook and brought it ahead. Yeah. And discussions in family households have started now, which is a good thing. But what I want to understand from you is when certain market cycles happen, right? And we recently are seeing changes in the GST, for example, or when in May there was so much volatility when the Operation Sindoor was happening, or the tariff thing, which is now erupted across the geopolitical thing. Does data on your platform show you that people start searching more or come more to the application, start looking at different products or something like that?
Yes, of course, it happens. And there is no way to control it, in my opinion, beyond a point. People behave very differently based on the environment around them. I think when it is about markets having a one-way rally, they tend to be over-optimistic a lot. And probably, I would not say they take more they make more investments. I wish they did. They take extra risk. So I think the behavior which probably we see is more of extra risk, overweight on risk assets and underweight on risk assets at the wrong time. I would not say everybody does that. Maybe a section of population does that. Maybe that population is actually reducing, fortunately, over a period of time because people are learning about markets a bit better. So I would say that the environment drives a lot more reaction than anything else. And if the environment is actually bullish, if markets have been bullish over a period of time, maybe a few weeks, a couple of months, you would see a smallest correction of 1 or 2 percentage points actually having a tendency to bring in a lot more flows. So we see that on the day of volatility, people end up investing a lot more compared to the days which are like usual half a point up and down kind of move. If you see a gap up opening, people will have different behaviors. But if you see gap down opening, you will see very different behaviors. Yeah, so I think the behavior they're exhibiting is a FOMO. That when the market was at slightly bullish kind of zone, and you were probably underinvested, and even a slightest correction makes you double down on the missed opportunity a lot more than they should. And in the phase where market continuously this 1 or 2 percentage point correction continues on a weekly basis or daily basis and continues for like more than a few weeks and converts into a few months, people actually become risk averse, and we would not really see a fag end of a kind of bear run. Nobody predict the bottom, but you would see that market is corrected significantly. Say what happened from September till I think early April. And if you see what flows industry got from Jan to March, most of the flows were in NFOs or thematic opportunities, but not actually coming into diversified equity mutual funds at all. That's because people actually have again taken a seat back because markets are not doing well. And to these opposite extremes, you keep seeing like there is a shared sense of optimism bias. There is a sense of FOMO at a slightest correction, and there is also this kind of I think I don't know if there's a bias or not, but kind of a penchant for collecting products. I think today we are seeing. I keep saying that probably we become shopper of investment products than investor in investment products.
How many funds in an average portfolio?
I think 9 to 12 is what we see in many portfolios.
That's average.
I would say median is about 9 to 12 range is what we would see depending on the month. I don't look at data very frequently on that side, but so we've just not become shopper in mutual fund products, but also we become shopper of collating different kind of bonds, different kind of FDs, different kind of unlisted products, PMSs, startup equity, what do you want to call it? I think is the e-com behavior now translated? Yeah, I think so. I think we've become shopper of investment products as a country, and the sense of structuring, having a structure to your investment decisions, a structure to your portfolio, maybe alignment with your goals, is going missing a bit. And I think again there is probably a behavior which we see to different segment of audiences. Once you hit a sizable portfolio, maybe the tendency to kind of collate more products goes down because you already feel that you need a consolidation of your investments than anything else. I think it's more about starter behavior and a slightly mature behavior. When you are starting up, a FOMO probably dictates more of your behaviors. But when you kind of have reached certain stage, and depending on the audience, a 10 lakh rupee can be large portfolio for many people. A 50 lakh rupee portfolio can be small portfolio for many people. Even a couple of crores can be like a manageable portfolio for many people in that sense. So I think everybody has that behavior of going for more FOMO kind of things, extra optimism, or maybe greed. I would say that I will not sell even if valuations are extremely expensive. Everybody in the newspapers, social media is talking about corrections is on the cards, but the greed just ensures that you stay invested. Anyway, if there was tendency or need to rebalance your portfolio and go back to your ideal allocation, you would not do that. So I think the behaviors are different when you have small portfolios or beginner in the investing journey. The behavior is different when you kind of have amassed about a sizable portfolio depending on your net worth.
Then you tend to bring down the number of holdings as you become?
I think so, yes. So that we do. So we have our investment advisory offering on ET Money. One thing that we observe and we want to correct it, but it's tough to correct, is that I think most retail investors in the DIY world of ET Money and an advisory world of ET Money have two stark behaviors. The DI world of ET Money will actually have lesser focus on quantum of investment he or she is making, and he or she will have kind of more extra focus on excessive risk, like excessive mid and small cap, excessive sectoral or thematic bets, versus the other kind of behavior. The risk is higher. So I think what we miss out is that ultimately time you give and amount you put in has biggest role to play in your wealth creation journey than actually the risk you take.
Yeah.
So I wish we can design for kind of solving these kind of problems. We always are at this challenge, and I think at some point of time we are confident we'll solve this problem.
A lot of debate between active investing, passive investing. You just said that you're a big proponent of passive first. Three things what you feel in favor of passive.
So I wouldn't say we are proponent of passive first. I think there is a need for a portfolio which is multifaceted in nature. Probably you need to take certain kind of decisions if you are a different kind of investor, and different kind of decision with different kind of investor. So I think maybe there can be people who can be active only, there can be people who can be passive only, people who will practice both as well. So to each his own is, I would say. When it comes to active fund, where we step down is just keep rewarding with more investments to the winners of the past. You can't be doing that. I think you can't be putting money by sorting the funds on returns without looking at the capability of downside protection of the fund. You cannot be putting money without understanding the investment philosophy of the fund manager. So I think once we get that right and we believe that we've understood right, we don't mind recommending active funds to you. So when it comes to active, I would say that you need to look at consistency of returns and intensity that the fund manager shows in terms of downside protection than actually going for just past winners. Right. When you go passive, I think it requires, passive investing and asset allocation can be probably practiced far better together than with active. Because when you're doing passive investing, you know what you own for sure. For example, when we buy an actively managed mid-cap fund, chances are very high that at least 25-30% of the portfolio will be either in mix of large and small caps, or maybe large caps, or maybe small caps. But you know for sure that 100% of the portfolio is not mid-cap. But when you buy a mid-cap index fund, you know for sure you're only holding mid-cap. Same goes for small cap, same goes for large cap. Large cap by definition allows only 80%. Like you can classify your fund as a large cap if you tend to have 80% on average into large cap, 20% can be anywhere else as well. So I think when you are an asset allocator and you want to really practice it well, and you want to ensure that I want to have a 60, 30, 10 of my equity into large, mid and small respectively, and just the money I want to put in debt or gold, you can ensure that the asset allocation and rebalancing, you can always keep in that same zone all the time at any point of every year. For example, you rebalance every year, you can come back to it. But when it comes to active, you may rebalance that you sold your large cap fund to come back to 60, you bought some mid cap fund to come back to 30.
Or the manager is changing.
But you at the back end manager would have changed allocations already. So I think if you are an asset allocator, then passive works really, really well for you. And you can control investments far better. But if you are somebody who is not a die-hard asset allocator for every investment goal or purpose you're making, you would tend to do well even with active, as long as you pick funds, not just past returns.
Right. I think that's an interesting take, that people, if you want to practice asset allocation, then the most important factor at the underlying is the risk parameter of the underlyings remain constant, or don't change too much, and that's how you can move around the allocation.
Like the overlap, like an overlap for a passive portfolio is always zero. Right. There is no way you will overlap. Some of the times when we look at active fund portfolios, maybe you are having 3 flexi cap funds, 2 mid cap funds, 2 small cap funds, 1 focus, and a dozen kind of things like that. And look at the overlap. You're owning all the 500 stocks. And the chances are very high in this kind of portfolio of funds, your return is going to be very close to index, depending on amount of flexi cap, large cap, mid cap, small cap, whatever. Either your return will be mimicking Nifty 500 index unknowingly, maybe Nifty 250 index unknowingly, or 200, or Nifty 100 or Nifty 50, depending on what you've done. And when you're basically wanting or chasing an index kind of outcome, why put money in actively managed portfolio? Go for index. But it's again the FOMO, the aspect of everybody has a specific fund A in the country. I don't have it. Maybe I'm doing something wrong. Let me buy it.
Sure.
People don't understand that ultimately all funds would actually have similar underlying holdings.
See, you did mention about, say, certain parameters when you're looking at, you said that, rewarding somebody with the money on the past performance may not be ideal.
Yeah.
Could you spell out maybe 3 things that one can do to ensure that they're going in the right direction? Of course, you can get it wrong.
Yep.
But there are higher chances of success in that case.
So I think there are multiple things you can look at, but I think what makes sense is, can I really, as a retail investor, identify that with my naked eye? That's more important. And I'm not sure how many people would be able to understand the impact of Sharpe ratio, information ratio, standard deviation, churn, expense, and all these 5 things, and the impact on the NAV. It's tougher in my opinion. So I think everybody would have read about all these terms, and if they're really interested to identify funds scientifically. But I think what comes closest in our opinion is, are you constantly generating returns? More important. So what we do is we look at consistency of returns. We look at a rolling performance of a kind of 3-year period, 1.5-year period, 5-year period, and try to come across at a weighted average score of the fund. How many times the fund was in top decile, top quartile, top 50 percentile, and so on and so forth. Similarly, we do the same thing on the downside protection. So how the fund actually is demonstrating the tendency to not fall whenever there's a correction in the marketplace. So again, we look at something we calculate internally is rolling drawdowns on a 1.5-year period, 3-year period, 5-year period, on a daily interval basis. So there are hundreds and thousands of observations, data available for both the things. We rate each fund that we qualify for rating on these 2 independent parameters. And then we actually give different weightage to both these things and do something called ET Money Fund Rank. So, and what we have seen over the period of time is, with this methodology, the funds that you typically pick as maybe top ET Money ranked funds are not necessarily the best performing funds on a trailing basis, on a 1-year basis, or a 3-year basis. But what you can really expect is consistency. And the churn in ranking, basically, like, the funds which were in top 5 1 year ago and the funds which are in top 5 next year, you would not find too much churn when you have this methodology. And I think basically practicing picking funds based on multitude of parameters like this is far better than possibly looking at simplistic stuff like expense ratio. Like, I have a different opinion on this. Like, if a fund is giving you alpha, and actually the difference between the first ranked fund and third ranked fund, second ranked fund is actually significantly large, not just over 1 year, but over a 2-year or 3-year period, and the expense ratio of that fund is actually about 30 basis point more, would you penalize it? I wouldn't do that. If the fund manager generating alpha, he or she commands that premium, why not give that premium? That a 30 basis points extra over every year that you're paying the fund manager, it's resulting into a couple of percentage point of alpha every year. It's a very good deal for the investor. So I don't want to kind of over prescribe that. Look at expense ratio, look at Sharpe ratio, look at information ratio, because we can't understand the statistical parameters. What we understand is how statistics actually is playing over a period of time with consistency, where you can pick up the winners.
Yeah. What's your take on the SIFs which are going to hit the market soon?
I think it's a very interesting kind of construct, in my opinion. Whether it becomes successful in attracting assets or not, I think is anybody's guess. But I think they serve a problem. I think with the uh, behavior that we all expect in terms of uh, taking excessive risk in markets today, and a lot of young investors dabble into derivatives, and I would probably call it speculative way of trading and not investing. Uh, I think they lack an access to product uh, which is managed by an expert. I think mutual funds serve a fantastic need where, or they serve the need in a fantastic manner where they bring in the expertise of a fund manager in picking securities to construct a portfolio, which a retail investor on his or her own on a brokerage app may not be able to do. They are amassing different stocks. They're expecting they were diversified, but they may not be paying enough attention to the businesses they've bought, or for that matter, the position size they have taken in each stock. A fund manager not just brings in expertise in terms of constructing a portfolio, allocating weightages, exposures, diversification of styles and market caps and sectors. That approach is missing when it comes to the derivatives access that people are getting on brokerage apps. And I think this FOMO is making them do it on their own a lot more. And maybe an SIF can serve that need, because at least I think majority of the SIF, I think there are 5 or 3 categories, right? And 7 categories. Okay. There are 7 categories, and I think most of it have capped at 25% unhedged portion, unless you are running a long short fund. So they actually get exposure to a 2-in-1 product, a long-term investing, as well as some kind of derivatives aspect in hedging their portfolios. And it is coming at a ticket size, which is at squarely sweet spot in today's world, in my opinion, between PMS and mutual funds. A lot of unauthorized or other unregulated entities are offering these kind of products today in the name of expertise. So I see that there's a very good thing happening for the industry. Now, whether the industry has enough talent to actually have 40 fund houses or 40 fund managers running so many different schemes, or even the markets are enough liquid to be able to run a large portfolio. I don't know whether most SIF funds can actually be bigger than 10,000, 50,000 crores. So I think there's probably going to be a size problem in this space. But I think 15,000 crore or 25,000 crore is a large number that can serve enough number of people. Not for reason of actually providing one more access window to customers, but more about solving a problem that they want to take exposure to derivatives for whatever reasons. And there is a structured way of getting exposure to derivatives for some part of the portfolio.
Sure. But I think any new product, when it launches, it's always has the other side, that how scalable it can become. Same thing would have happened for mutual funds many years back.
Yeah.
For probably PMSs at some point of time, but both these industries have built and grown.
Yes.
So
yes.
Moving on to the current status of the economy, where we are with what's happened globally, probably new alliances, new world order. If you're a young investor today, trying to come to online platforms like yours, trying to search, and if he has to choose like maybe 3 sectors where he should put his bet for the next 10 odd years, then as per you, what it could be?
I'm not a market expert, honestly. Probably I can excel at allocating assets across different asset classes for you, but may not be able to answer that question with confidence. I think it's very difficult to predict long term. Building a portfolio of stocks over the next 10 years is very tough, being a person who's not managing stocks directly. But I think that there is a lot more value available today in being picking kind of banking and financial services sector, because that is one segment of the market which is completely underperformed, be it with respect to small and mid cap indices, or for that matter the different sectors itself. So I think a lot more people who actually want to be sector specific or want to be stock specific can do so by getting some exposure into BFSI. I don't have any other understanding of the space in terms of going into listed space. But if one is wanting to really get exposure or build their careers and not just invest in portfolio, I think the world of fintech is probably a very big opportunity for many people. I think nobody anticipated what fintech is going to be in 2025, sitting in 2015. I think we talked about all these digital infrastructure of the government, which has helped build fintech businesses today. But the amount of trust the investors or end users are exhibiting in transacting or being comfortable with money management online, be it for payments, be it for bank transfers, be it for doing broking or a trading in that sense, or for that matter, investing for long term, is so kind of widespread today that maybe we are going to see a digital bank in the future for sure. And whether it happens in a decade or 2 or 5 years, nobody knows that. But one thing is for sure, that fintech is probably going to transform the entire financial landscape for good for the industry as well as for the consumers. And I think getting exposure to that probably can be very opportunity for people.
And what do you have to say to people who say that we don't trust machines taking decisions for us? What's your saying in that?
I think to each his own. I think everybody is comfortable machines taking decisions for certain aspects of their life. I can talk about what we see in our real life. Many people on fintech applications or wealth tech applications, if you ask them why they didn't really end up investing on the app after downloading the app, they would say they couldn't really figure out what they should be investing in. They couldn't take a decision. And the same set of users you speak to about how did they book their last holiday to Europe, and they would say they would actually go for any other online travel portal and end-to-end book the package, or basically planned flights separately, hotels separately, sitting on that app or website on their own. So the same customer, when it comes to taking decision for a 5,000 rupee SIP product, was not able to take a decision because of lack of trust or lack of capability, what you want to call it. But the same customer was able to buy maybe a 10 lakh rupees worth of travel package sitting on his laptop or mobile application.
It's a trust issue.
I think it's a comfort issue with the category. So sometimes you think that you can't take a decision on finance, but you can take a decision on travel. Some people will think I can take a decision on health, but I can't take a decision on travel. For me, it can be I can take a decision on money, but I cannot take a decision on travel. So I think everybody outsources the decisions to machines today, unknowingly for some categories. So it's just that somebody may not be comfortable when it comes to trust equation with money management online, but they're comfortable with different categories. So I think at some point of time, the world of machines or AI is penetrating into our lives. We were just talking about before the podcast began about how we trust Google Maps, that Google Maps will take us to a specific place, even when almost all of us have some kind of bad experience in the past. But the trust equation is so high because it has not let you down 9 out of 10 times or more than 2 out of 10 times. Yeah. So it's like the experience builds up on different categories over a period of time. And I think the trust probably comes into that another category as well over a period of time.
Santosh, it's a pleasure talking to you about the technology world and how it's evolved and all. One question which is intriguing me is, if you had to start today to build something, how would you do it differently today, or you would have followed the same path?
You mean for
as a business, as a technology business, assisting B2C customers to come and take financial decisions?
I think so. Of course, everybody makes mistakes. We have done truckloads of them as well. I think the fundamental belief will remain same, that we are very clear that we are not here to sensationalize investments. We are not here to make you speculate. We are not here to do overpromise and just ignore risk. So those underlying philosophies will always remain same. We are very careful about what we bring to the app and how we operate. But if we were to start all over again, maybe I would not have focused on getting the transaction journeys as much right today than getting information right. Maybe I would have not focused on trying to make people stop from every mistake and failing at that, because we have worked very hard in making, say, sectoral funds a bit behind behind a few taps. You can't find them easily. But when there is a kind of momentum in the sector, in the market, people end up finding them and buying them. So I think one learning that we have had is you can't stop the customer from doing what he or she is decided in their mind.
Yeah.
What you can do is probably educate them, do it in balance. And if you do that, then probably you build an equation with the customer of empathy and a friend and not a big brother. And then that relationship can actually help you do the same things which you wanted that customer to avoid. Or rather avoid, and you are successful at making them avoid. I think at ET Money, we have done that thing a lot, where we have possibly tried to hide away a lot of bad products, a lot more than we should. It's not that we wanted to sell those products, but sometimes people just complain that this kind of fund is not available on ET Money because they're able to find it. Yeah. So I think that's one aspect where maybe when customer is expecting that you are an access provider, you play the role of access provider. If the customer is expecting you to play the role of a wealth manager, you play a role of wealth manager. If a customer is expecting you to play the role of information delivery and tools for decision making, you play that role. I think playing one role all the time, when the customer is not clear what role they expect from the app, probably helps you devoids you of doing a lot more in customer's life than you should. So I think that's one learning that we have had over last period of time, and I think we are addressing that in next few months. Let's see.
I think that's a 0 to 1 masterclass for people who are getting into this business and trying to make a difference. That be a friend, don't be a big brother.
Yep.
Interesting. Just before we let you go today, 3 quick questions. A movie which has had an impact, a book which has had an impact, and what's your favorite pastime outside your office space?
I think movies, there are many. Maybe because today you watch so much today on OTTs that you tend to forget what you watched yesterday. So I think movies, there are many. I honestly cannot easily pick up one or two which has had big impact. I'm sorry, I'm not able to recollect. But books, if you ask,
or a web series, whatever, it's up to you.
Yeah, even web series. I think I watch so much. I'm a OTT and Bollywood buff. I watch a lot, and many movies would have many big impact on me. I think maybe Swades had a very big impact. Changed my thinking a lot more. I never went to build career outside of India. Had many opportunities. Almost went once, but never felt to move. And when I watched Swades, I felt that I did the right thing. So I'm not saying Swades had impact, but I think there are a lot of movies which make you kind of move. I think may not be having impact, but there are a lot of old Indian movies which I tend to watch again and again.
Which is a favorite go-to?
I think in the late kind of last decade or so, maybe Zindagi Te Milan Dobara had is something which I can keep watching.
Sure.
Maybe at any point of time, I can just switch it on, and for me, it's like a series which just starts. And in the I think maybe I was child at that point of time. Jo Jita Wahi Sikandar or like Andaz Apna Apna are the kind of movies you can watch again and again at any point of time. You don't need a mood for that kind of movies. So I think I'm not able to recollect a lot of other movies because I watched so many of them. And I watch movies a lot of times which people will never go and watch in theaters. So that happens a lot. But books actually have
Off camera, I'll check with you.
Sure. So I think books, I read a lot. I read less today compared to what I used to do. But one book which had tremendous impact on my daily life, and it actually demonstrates itself on a daily basis, is Atomic Habits by James Clear. Had I not read that book, I would not probably have taken health and fitness as I should, and I do it different way compared to what I used to do earlier. How I really organize my day at times has a lot more to do with James Clear and Atomic Habits learning than anything else. I love that book. That changed my life. I think reading Atomic Habits made me read many books on habit building. I read a book called Good Habits, Bad Habits. I read a book called How to Change. And all these are habit forming books. And again, at 28, 30, 35, I never felt I would read self-help books. So maybe Atomic Habits is one self-help book which has changed my life. I actually have been reading, I'm yet to finish, is Thinking Fast and Slow. Yeah, Thinking Fast and Slow. I've been reading this book almost for over a year. I don't read this as a target to finish. I read that book to really understand the biases that we all have and how we take decisions. A lot more of ET Money's marketing communication is picked up from how Daniel Kahneman writes about the decision making process we have. I think that's one book probably you can read 10 times in life, and maybe there'll be something else to take away from each chapter. So Thinking Fast and Slow is one book which
like a vantage point. You see different places and you get different perspectives.
Yes. I think, and I know it's so heavy book, of course. So you can't really just flip that through and finish it off like an Atomic Habits is. So you have to really have a frame of mind to read that. So maybe I'll pick it up over once in a few weeks because you need mindset to read that book. But it changes how you think differently. And I think after reading that book, you think yourself that you are so bad at decisions. You made this decision so wrongly. You just exhibited this bias just about a few hours ago. I think that's a fascinating book about human decision making.
And when you're off work, what's your favorite pastime?
I like to talk to my son.
How old is he?
He's 11. He actually is kind of into different things. He likes to do things with his hands a lot more. He keeps changing from cubing to origami to drawing to Legos to smart TVs. Is into sports, plays football and tennis. So just talking him out what was his day like and how he's doing certain things. And it's up to what he watches and what he shares, how he learns things, how he picks up things is fascinating for me. So I do spend a lot of time with him on weekends. I try to do as much as I can, but I don't think I spend enough that I should.
Does he have any view on money skills?
I think because he hears a lot about ET Money, he has. I think he's going to be a better person if at all he pursues business. Maybe better than me for sure, in my opinion, because he has this aspect of exchange of economic value, probably far more ingrained in his head than probably I had at his age, or maybe I have even today. So maybe kids are built differently today than what we were in those days. So he has this aspect of money, but I don't think he understands the value of money or kind of understands what quantums are in that sense. But he has this aspect that there is something called investments. There is something called stock market. There's something called mutual funds. And he does refer these things at times in our conversation.
I'm sure once he watches this podcast, he would know exactly what his dad does.
I
Much
don't.
more detail.
Uh,
Probably his way of explaining money skills to people.
no, so he actually knows a lot. So when he was younger, like maybe 8 years old, he used to tell me, I watch video, and if you don't get me this, I'll dislike this. So he understands the importance of like ratio in terms of that video coming in your recommendation list and things like that. So he has his way of understanding money. I'm sure he understands a bit about loans and insurance as well because of how we talk at home with my wife. And of course, because I exchange a lot with my wife and I get back home about how our businesses and things like that are. And he picks up from there for sure.
So if you're watching this episode, do like, share, and subscribe to this video. Santosh, it's been a pleasure talking to you.
Same as me. Thanks for having me here. Thank you.
Thank you, everyone. That was Let's Tech with Santosh from ET Money. We'll see you on another episode next time. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.